Hmm? No? Yeah. I'm audible. Arun Venkatesh. Good morning, everyone. Good morning. Good morning. Happy Holi. Good morning, Prasanna. I hope you are fine. Okay. I have started recording SFM marathon. I request all Sahas students to listen marathon classes. So I have started SFM marathon in English. Thank you, Niharika. Thank you so much. So I have recorded English marathon. Okay. So by next Saturday, we would be releasing SFM marathon English class. I request all Sahas students to listen this marathon. So right now we are discussing portfolio management chapter. So immediately after completion of portfolio management chapter, I recommend you to watch marathon immediately. So for practice. Okay. So that's why I took break on Saturday. I was not able to take class at morning 7 o'clock because I slept at 6. That's why. Okay, I thought of to take class, but I couldn't. So I will be releasing SFM marathon. Actually, I thought of to release SFM marathon in the month of May. But again, due to request of many students, I'm releasing SFM marathon next Saturday. Okay. So I request everyone to watch this marathon at least twice to get good results. Clear? Veena, you completed group 4 also or only group 3? What about group 4? Shilpa Mandadi, Jamuna, Lakshmi Prasanna, Parvati, Arun Venkatesh, 1.5 crores. Okay, shall we start? I think I gave you a homework. I asked you to solve a question number. Okay, I have given work to solve additional questions, and at the same time in main questions I have asked you to solve question number 22, right? Okay. Now we shall start with question number 22. Question number 22. An investor holds two stocks A and B. An analyst prepared ex ante probability distribution for the possible economic scenario and the conditional returns for two stocks and the market index as shown below. Economic scenario: growth, stagnation, recession. Probability 0.4, 0.3, 0.3. Conditional returns A, B, and market. The risk-free rate during the next year is expected to be around 11%. Determine whether the investor should liquidate his holding in stock A and B, or on the contrary, make fresh investment in them. CAPM assumptions are holding true. CAPM assumptions are holding true. So, understanding the question is very important, because here the question is determine whether the investor should liquidate his holdings. Investor should sell his holdings, or on the contrary, that means on the opposite side, make a fresh investment. That means whether he has to sell the security or buy the security. So that we have to determine. Okay. To determine whether to buy the stock or sell the stock, what we should do? Tell me the answer. We have to calculate the expected return, CAPM return, and we should compare CAPM return and actual return, nothing but average return. Yes or no? If actual return is greater than CAPM return, that means we have to buy. Okay. If actual return is less than CAPM return, then we have to liquidate the holdings. Liquidate means sell. Sell the securities. Excellent, Sai Ganesh. Now, so first we have to find out actual return, nothing but X bar, Y bar. Nothing but average return itself is considered as actual return here. Okay. And we have to find out the expected return. So expected return, that is CAPM return, depends upon the risk factor, that is beta. Yes or no? So risk-free rate is given in the question, RF. RM is not given in the question. So this M bar is nothing but RM. M bar is nothing but RN, market return. Now my question is, so first you have to refer this question multiple times, because you must be able to understand the question. The question is, determine whether security should be sold or bought. For that we have to compare CAPM return and actual return. CAPM return and actual return. Okay, done. So now my question is, how to find out CAPM return? CAPM return is equal to RF plus RM minus RF into beta. So we have to find out the beta and we have to find out RF. Yes or no? Okay. So first we have to find out beta. What is the formula for beta? When more than two data is given, when more than two possible returns are given, or when more than 2 years data is given or 2 periods data is given, then the beta formula is covariance of S comma M divided by sigma M square. Beta is equal to covariance of S comma M divided by sigma M square. So this is the formula. Okay. So now for finding out covariance of sigma, security and market. So two securities are given, A and B, and market is also given. Okay. So first we have to find out the beta of A and then beta of a B. Yes or no? Shall we start? Are you able to get my point? Already I have told you to solve this question. I gave you homework. I hope everybody tried this question. Shilpa, Prasanna, so Parvati, Are you there, Parvati? Okay. So now, Sagiresh, did you mention in the group about the class? Okay. Okay, you showed the link also. Okay, done. Shall we start calculation? Question number? Question number 22. Okay. So question number 22. Working note 1. Calculation of beta of security A. Okay. So for that, first we shall start with A variance of a market, that is sigma m square. Variance of a market sigma m square. Yes or no? So what are the columns of variance of market sigma m square? Probability is given in the question. So that's why what are the columns? M P P into M, M bar, M minus M bar, P into M minus M bar square. Clear? M. So tell me M. 18, 13, minus 3. What about probability? 0 0.4, 0.3, 0.3. 0.4 into 18. 7.2, 3.9, minus 0.9. 10.2. 10.2 is M bar. So M bar 10.2. M minus M bar. M minus M bar 7.8. 2.8 minus 13.2. Next P into M minus M bar square. P into M minus M bar square. What? 24.34, 2.35, 52.27, total 78.96. This 78.96 is nothing but variance of a market. Yes or no? Variance of a market. Okay. Done. Shilpa. Very good, Amma Shilpa. So next, after finding out variance of market, we have to find out covariance of A comma M. Yes or no? Covariance of A comma M. So what are the columns for covariance of A comma M? Columns for A comma M. A A and then P into A bar, A minus A bar, M minus M bar, P into DA into DM. Deviation of security A into deviation of a market. Yes or no? What is A? 25, 10, minus 5. What about probability? 0.4, 0.3, 0.3. So 25 into 0.4, 10, 3, minus 1.5. Yes or no? So 11.5 is the answer. This 11.5 is nothing but the average return of a security A. We compare this average return with CAPM return. CAPM return is nothing but required return. So A minus A bar, 13.5 minus 1.5 minus 16.5. What about M minus M bar? 7.8, 2.8 minus 13.2. Clear? Next P into dA into dm. Probability into deviation of A into deviation of a market. Yes or no? So P into deviation of A into deviation of a market. 42.12 minus 1.26, 65.34, 106.12, 106.2. What is this 106.2? This 106.2 is nothing but only Shilpa is responding. What about others? So 106.2 is nothing but covariance of A, comma N. Next C. Beta, or else we shall change the heading. Calculation of beta of a security A and B. For finding out security A and B, for finding out beta of a security A and B, we have to find out covariance of a B comma M. Yes or no? First variance of market and then covariance of A comma M and next covariance of B comma M. You might find different presentation in our book. Okay, so just note down the presentation. Just observe the order. Covariance of a B comma M. Covariance of B comma M. So columns B, P, P into B, B bar, B minus B bar, M minus M bar, P into deviation of B into deviation of a M. B 20, 15 minus 8. Probability 0.4, 0.3. Next P into B 8, 4.5 minus 2.4. What about B bar? 10.1. B minus B bar 9.9, 4.9 minus 18.1. Yes or no? Next M minus M bar. M minus M bar. M minus M bar 7.8, 2.8 minus 13.2. Next, P into deviation of a B into deviation of a market. We are finding out the covariance of B comma M. In this question, we are going to learn a new point. Just wait for some time. Okay. We are talking about portfolio revision. I hope you remember the steps in portfolio management, activities involved in portfolio management. Okay, so P into deviation of a B into deviation of a market. 30.888. Thank you, Shilpa. 30.888. 4.116. 71.676. So total, what is the total? 106.68. Is it right? Covariance of B comma M is equal to 106.68. 106.2 is beta of a, covariance of A comma M. Covariance of B comma M is equal to 106.68. Is it right? Done. Others, please respond. You have to find the values. I can teach concept, that's it. Tell me the values. 106.68. Is it correct? Jamuna, okay, done. So now beta of A is equal to covariance of A comma M divided by sigma M square. What is the answer? Karthikeyan, 106.2 divided by variance of market 78.96. What is the answer? 1.345. 1.345, yes or no? What about beta of a B? Covariance of B comma M divided by sigma M square. 106.68 divided by 78.96. What is the answer? 1.35. Clear? Now, let us conclude. What is the main answer? Main answer. Happy Holi, Shashank. Now we have to find out what CAPM return. We have a concept of Jensen alpha. Jensen alpha. What is this Jensen alpha? Jensen alpha is equal to actual return minus CAPM return. So this is the main answer. Jensen's alpha is equal to actual return minus CAPM return. This is calculated to decide whether to buy new securities or sell the existing securities. Okay. So Jensen's alpha is calculated to decide whether to make a fresh investment or to liquidate the existing investment. So Jensen's alpha is equal to Jensen's alpha. So this is the main answer. Jensen's alpha is equal to what? Actual return minus CAPM return. Okay. So now security A. Security A. What is the actual return? Here the actual return means nothing but A bar. Actual return means nothing but A bar. A bar is equal to A bar already calculated in the question. 11.5 is nothing but A bar. Yes or no? So 11.5. This is the return, average return. Security is going to give us 11.5. But whereas we require how much? Are you getting my point? 11.5. But whereas what is the risk-free security? 11% plus RM. RM is nothing but M bar. What is M bar? Please be fast, okay? I know it is Holi. You might be expecting holiday. So 11% plus M bar 10.5 minus 11. So 10.2. Mallikarjun, please. 10.2 minus 11 into what is the beta? 1.345. For security A, I have already told you to solve the question. So 11.5 minus clear. So what is the answer? What is the Jensen's alpha for security A? Jensen's alpha. I am asking about Jensen's alpha. CAPM return. Actual return minus CAPM return is the Jensen's alpha. I am asking you about Jensen's alpha. What is the answer for Jensen's alpha? 1.572 percentage. So this is the Jensen's alpha, or 1.576. You might get 1.576. Okay. So this is the Jensen's alpha. Let us understand what it is. Nothing but we are comparing the actual return with CAPM return. Here 1.576. What does it denote? Our actual return is greater than CAPM return. Our actual return is greater than CAPM return. So that means what? So we have to sell the security or buy? We have to buy the security. Because our expectation, our required return is 9.924 percentage, but whereas security is giving 11.5. Security is giving more than what we are expecting. So that's why we have to make a fresh investment. Okay? Yes or no? That means nothing but simple. If a Jensen's alpha is positive, that means the security is underpriced and we have to buy the security. Okay? Next is security B. Security B. What about security B? Security B bar 10.1 minus 11% plus 10.2 minus 11 into 1.35. What is the answer? Positive or negative? Positive. So again, in security B also we have to make a fresh investment. Since the Jensen's alpha is a positive, as the Jensen's alpha is a positive, we have to buy the securities. We have to buy securities. Done. Shilpa, Karthik, everybody please respond. So now in this problem we have learned a new concept. Even without calculating Jensen's alpha also, by comparing actual return and CAPM return, we can decide whether to buy the security or sell the security. But whereas in suggested answer, okay, board material answer, so they have calculated Jensen's alpha and they gave the answer. Clear? Are you getting my point? If Jensen's alpha is positive, we have to make a fresh investment. Are you able to understand the logic? Okay. Let me revise once again. What is our chapter? Our chapter is portfolio. Yes or no? First, you should be able to know what are the columns to be taken. What are the columns to be taken? For sigma x, what are the columns? X, x bar, x minus x bar, x minus x bar square. This is when past data is given. This is when past data is given. Okay. So when future data is given, then columns will be x, p, p into x, x bar, x minus x bar, and p into x minus x bar square. Yes or no? Okay. I hope you remember the formulas, but I'm just revising what are the columns to be taken. Next, for covariance of x and y, what are the columns? X minus x bar, y minus y bar, x minus x bar into y minus y bar. Why? Because why? Just ask yourself why. Why these columns? Risk means possibility of a deviation from the average return. Yes or no? So that's why we are finding out x minus x bar. X minus x bar is nothing but deviation from the average return. Yes or no? Okay. And y x minus x bar, y minus y bar, and x minus x bar into y minus y bar for covariance of x comma y. Because covariance of x comma y denotes co-movement of a securities. Co-movement of a securities. So that's why x minus x bar, y minus y bar. We are multiplying the deviation of x with deviation of a y. Okay, done. Covariance of x comma y, fine. The next one. After covariance of x comma y, if a probability is given, then x minus x bar, y minus y bar, last column p into dx into dy. Nothing but probability into deviation of security x into deviation of a security y. Yes or no? So this is the formula for covariance of a x comma y. Y can be marked, depends. They may ask you to find out the covariance of security x comma security y. That denotes co-movement of security x and y. But whereas while calculating beta, we would be finding out covariance of s comma m. What is covariance of s comma m? It denotes covariance of security and market. It denotes co-movement of security and market. If it is security A, then we find out covariance of A comma M. If it is security B, we find out covariance of a B comma M. Okay, fine. So covariance of a S comma M. M means market index. M means index. And next, If they ask you to find out the beta, first you have to find out variance of a market. First we have to find out variance of a market, then proceed to calculate covariance of a security and market, and then beta. Are you getting my point? Why we are learning beta? So just understand the flow. First we learned how to find out the return of a security, that is X bar, Y bar. Next risk of a security, that is sigma X, sigma Y. And then return of a portfolio. Return of a portfolio is nothing but weighted average of a security returns, that is WX, X bar plus WY, Y bar, and so on. What about the risk of a portfolio? For risk of a portfolio, we have to consider correlation coefficient, closeness of a securities. So that's why Markovitch modern theory has suggested a formula. So what is that formula? Square root of, so for risk of a portfolio, sigma p, what is the formula? W x square sigma x square plus wy square sigma y square plus 2 wx wy sigma x sigma y sigma xy. Some students might be thinking, sir, why you are taking this much time for portfolio? Because this is very important. With portfolio management, mutual funds, and derivative analysis, with these three topics itself, we can score above 50 marks. So that's why. Okay. I won't be taking much time for international financial management. International financial management topic, we can complete it in 1 hour. Interest rate risk management, that topic can be completed in, okay, main questions can be completed in 1 hour. Additional questions, I might take 2 hours. So hardly 3 hours. Okay. Securitization 1 hour topic. Digital finance 1 hour topic. Security analysis 1 hour topic. Okay. So, and security analysis weightage is also only 2 marks multiple choice question. Okay. Clear? Are you getting my point? So square root of, and about leasing evaluation of scheme proposals, that can be completed very easily because already you have a basics in CMA Inter. Clear? So this is the formula. This formula is similar to a square b square 2ab. Yes or no? Clear? If there are 3 securities, then formula will be similar to A plus B plus C whole square. Nothing but you will take A square, B square, C square, and 2AB, 2BC, 2AC. Clear? Are you getting my point? So generally, they won't ask you to find out the risk of a portfolio containing 3 securities. Okay. So containing 3 securities from the beginning. They won't ask you to calculate the risk of a portfolio. So from the beginning means first we have to find out sigma AB, sigma BC, sigma AC. So that will take a lot of a time. So that's why they will give sigma AB, sigma BC, and sigma AC in the question. And then they ask you to find out the risk of a portfolio. Clear? And next, this is risk of a portfolio. So risk of a portfolio, this formula will be applied when sigma xy ranges from -1 to 0 or 0 to 1. Yes or no? Okay. So but whereas when sigma xy is equal to +1, then what is the formula we are going to apply? The formula we are going to apply is sigma p is equal to wx sigma x plus wy sigma y, because securities are moving in same direction, that too in same proportion. We cannot diversify the risk. So that's why risk of a portfolio is nothing but weighted average of a security risk. That's it. But whereas sigma xy is equal to -1, then risk can be fully diversified. Risk can be then what is the formula? Wx sigma x minus wy sigma y. Clear? Okay. In this case, risk can be reduced up to 0. Risk can be reduced to 0. For that, we have to take proper proportions. We have to make investment in proper proportions. So weight of x must be equal to sigma y divided by sigma x plus sigma y. Yes or no? If sigma xy is equal to 0, okay, if sigma xy is equal to 0, then sigma p is equal to square root of wx square sigma x square plus wy square sigma y square. Yes or no? Okay. If security y is risk-free security, if security y is risk-free security, then sigma p is equal to wx sigma x. Yes or no? I think I'm telling this point for the first time. If security y is risk-free security, okay, then standard deviation of risk-free security is equal to 0. That means b square will become 0. And what about this 2ab part? 2ab part will also be equal to 0. Correlation coefficient of x comma y will also be equal to 0. So that's why standard deviation of portfolio is equal to simple weight of x into standard deviation of x. Are you getting my point? And next. So what is sigma xy? Sigma xy is a correlation coefficient. How to find out correlation coefficient? Covariance of x comma y divided by sigma x sigma y. I'm sorry. Covariance of x comma y divided by sigma x sigma y. Yes or no? Okay. And next, when correlation coefficient is other than -1, risk cannot be reduced to 0, but risk can be minimized. So for construction of a minimum risk portfolio, proportion of a x, weight of a x must be equal to sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. Are you okay? Done. So this formula can be applied to find out optimum proportion, best proportion, when correlation coefficient is other than -1. Are you clear? Okay. And next, total risk is equal to systematic plus unsystematic risk. Unsystematic risk can be by diversified. Systematic risk cannot be diversified. So beta denotes a systematic risk. Beta denotes responsiveness of a security return with respect to change in market. So beta of a cash is equal to 0. Beta of a risk-free security is equal to 0. Yes or no? That means risk-free security will not respond to okay. Are you getting my point? Done? So beta formula, beta is equal to when only 2 periods data is given, then change in security return divided by change in market return. Change in market return. Okay, done. Next, when more than 2 years data is given, then covariance of S comma M divided by sigma M square. Okay, what is the second? Sigma Sm into sigma S divided by sigma M. Covariance of security and market into standard deviation of security divided by standard deviation of a market. What does beta denotes? Beta denotes systematic risk. See the flow. Security return, security risk. Portfolio return, portfolio risk. Total risk is equal to systematic risk plus unsystematic risk. Beta denotes a systematic risk. Now we have discussed how to find out beta. Okay, done. So for finding out beta, it denotes responsiveness of market and security. So that's why what is the first step? We find out the variance of a market, and then we find out the covariance of security and market, and then we find out beta. Clear? Am I clear? The next point is, later on we have learned the concept CAPM return. RF plus RM minus RF into beta. I hope you understood the logic for this one. If it is a risk-free security, investor would expect risk-free return. If he is not taking any risk, he would expect risk-free return. But however, if he is making an investment in market, then he will expect RM. If he is making investment in market, he will expect RM, market return. Clear? Beta of a market is equal to 1. Why? Market changes by 1% with the change in market by 1%. Yes or no? So beta of a market is equal to 1. So obviously, the person who is making investment in market would expect market return. What about a person making investment in security? He will be expecting security risk premium. RM minus RF is market risk premium, but whereas RM minus RF into beta is a security risk premium. Okay. If a beta increases, security risk premium increases. Yes or no? And one more point I have forgot to tell. In last question, that is a rare case. Risk-free rate is 11%, but whereas the market return is 10.2. So practically that doesn't happen. You are making an investment that means you are taking a risk. Then obviously the return would be definitely higher than the risk-free rate. But whereas in the last question, I think risk-free rate 11% and market return is 10.2. Okay. So CAPM return. Why we are finding out CAPM return? For pricing the security. For pricing the security. So we learned time value of money, and in that, so the one of the main formula we have applied is dividend discount model. D1 divided by KE minus G. Yes or no? This formula is similar to the fifth example. For this concept, I have discussed time value of money concept. To explain this D1 divided by KE minus G, I took 1 hour for explaining time value of money. Okay. So CAPM return is used for finding out the price of a security. Capital asset pricing. Capital asset pricing. Okay. So D1 divided by KE minus G. So this is also known as equilibrium price. Theoretical price. We compare this theoretical price, that means price calculated using CAPM return, with actual market price, and we decide whether to buy the security or sell the security or hold. You apply the common sense, please do not buy heart. If as per our theory the price is 20, but in the market the price is 50. As per your theory, price is 20, but whereas in the market the price is 50, you're going to sell the security. Yes or no? For example, your father and mother might not be having a knowledge of portfolio management. But whereas if they have a land, and as per their theory, the land worth is 20 lakhs, but whereas in the market the price is 50 lakhs, obviously what they will do? They will sell the land. Why? In their perception, the land value is 20 lakhs, but whereas in the market the price is 50. Yes or no? Likewise, hmm, hmm, hmm. Then obviously we are going to buy the security. Obviously, We sell the security. Even in case of a security also, if theoretical price is 20 and the actual market price is 50, you will be selling it. You're not going to buy it, you are going to sell it. Because in your perception, the security worth is only 20. What you will do? Are you getting my point? So market price is 50. You will sell the security. Okay, done. For example, whereas in the market, if our security is priced at rupees 10 in the market, then I will buy it. Okay. When you compare the actual market price and equilibrium market price, then okay, you will not get confused. And when you compare the actual return and CAPM return, actual return and CAPM return, then your thinking would be different. You have to apply the common sense. You should not by heart. Okay. So coming to next point. After seeing this equilibrium return, CAPM return and price calculation, and later on we have learned a Jensen's alpha. Jensen's alpha means nothing but actual return minus CAPM return. For suppose if these are not market prices, for suppose if these are the percentages, 20% is the actual return and 50% is the CAPM return. Okay. Then what you are going to do? Okay. Suppose, sorry, let us assume this 20% is the CAPM return. 20% is CAPM return and 50% is the actual return. Then what you are going to do? Let me explain again. 20 is the 20 rupees CAPM equilibrium price. Okay. Market price 50 rupees. Okay. You are going to sell. Yes or no? Okay. Why? As per your theory, the price must be equal to 20. But whereas in the market, the price is 50. So that's why you're going to sell. Next. CAPM equilibrium price is 20. But whereas the market price is 10. As per your theory, the security worth is 20, but whereas in the market the price is 10. What you are going to do? You are going to buy. Let us, okay, compare returns instead of a market price. For suppose CAPM return. Now I am not taking CAPM equilibrium price. I am taking CAPM return. It is 20%. CAPM return is 20%. And the actual return or average return is 50%. So, what is your required rate of return? 20%. But whereas the security is giving 50%. What you are going to do? You will buy it. Jensen's alpha is positive. Actual return 50 minus CAPM return 20. Jensen's alpha positive 30%. You are going to buy it. Are you able to differentiate this? Please do not by heart. You have to apply common sense. If 20% is the CAPM return and the actual return is 10%, then sell the security. CAPM return is 20% and the actual return is 10 percentage. Then we sell. Why? For the risk we are undertaking, security must give 20% return, but whereas it is giving only 10 percentage. So we sell the security. Are you okay? Are you able to understand why we are calculating? Why? Are you able to understand why portfolio management, why risk of a security, why return of a portfolio, why risk of a portfolio, why we are learning beta concept? Why we are learning beta concept? If we can find out the beta, so that we can find out CAPM return. If we can find out CAPM return, then we can find out Jensen's alpha. If we can find out Jensen's alpha, then we can decide whether to make a fresh investment or sell the security. Portfolio revision, portfolio evaluation. For evaluation of portfolio, we can use this Jensen's alpha. Clear? Done. Next concept, we have a Sharpe ratio. Not as discussed, Sharpe ratio, Trainer's ratio. These Sharpe ratio, Trainer's ratio, and Jensen's alpha, these three are used by the mutual fund managers to decide whether to make a fresh investment or sell the securities. So simple. What is the Sharpe ratio? Sharpe ratio is equal to RP minus RF, RP minus RF divided by sigma P. What is that one? Are you getting my point? RP minus RF divided by sigma P. Let us understand what does it denote. It denotes excess return. RP minus RF. RP minus RF, what does it denote? It denotes excess return. Excess return per 1% of a risk. For example, sigma of RF is equal to 0. Yes or no? Standard deviation of risk-free security is equal to 0. But the standard deviation of portfolio might be 10%. That means we are taking risk. We are making portfolio investment means that we are taking risk. So sigma RF is equal to 0. What about sigma P? 10%. Next, RP is equal to 15% and RF is equal to 8%. What is this? Risk-free rate is 8%. What does it indicate? Without taking any risk, we are able to earn 8% return. By taking 10% standard risk, we are able to earn 15%. How much excess are we earning? Excess we are earning is 7%. Okay. Yes or no? 7 divided by 10%. You will get 0.7. This is the ratio. What does it indicate? For every 1% extra risk, you are getting an excess return of 0.7. For every 1% extra risk, you are getting 0.7 return. For example, the other security is giving 25% return and the risk is 12%. Risk is 12%. Then what is your answer? What is the excess return you are getting? The excess return you are getting is 25 minus 8 divided by 12. So 25 minus 8 divided by 12. So which security is best? Second one. Higher the Sharpe ratio, better it is. Higher the Sharpe ratio, better it is. Clear? So mutual fund manager will decide which security should be selected based on a Sharpe ratio. Okay. Trainers ratio. What is the trainers ratio? Simple trainers ratio. Sharpe ratio denotes excess return per unit of total risk. Total. But whereas trainers ratio denotes excess return per unit of systematic risk. What? Per unit of a systematic risk. Nothing but the formula is RP minus RF divided by beta P. RP minus RF divided by beta P. If it is a portfolio, the formula is RP minus RF divided by beta P. If it is a security, then RS minus RF divided by beta SS. If it is security, then our formula will be RS minus RF divided by sigma S, Sharpe ratio. What about trainers ratio? RS minus RF divided by beta S. You have to apply the common sense. First, you understand the meaning. What is the trainers ratio? It is an excess return per unit of systematic risk. If it is security A, then our formula will be RA minus RF divided by beta A. If it is portfolio, then formula is RP minus RF divided by beta P. Are you getting my point? Okay. So this is the trainers ratio and Jensen's alpha. Already we have learned about Jensen's alpha. Jensen's alpha is equal to actual return minus CAPM return. Excess return per unit of total risk. Standard deviation is total risk, no? What about beta? Beta is a systematic risk. So trainers ratio indicates excess return per 1 unit of a systematic risk. Clear? Yeah. Clear? Okay. So I recommend you to, I will give some work with this background. Question number 26. First you solve. Tomorrow I am going to discuss. Are you having class in second session? What is schedule for today? Today is Holi, no? Holi today or yesterday? Okay. 26th. You can try 26th question. 27. Tomorrow again I will discuss as if I have not given a homework. Are you noting down? You will get perfection. Please do homework, okay? Okay, in second sum. Where is the characteristic line? Okay. If you are not able to solve, then okay, no issue. And in additional questions, question number 5. This is CA final May 23 question. This CA final May 23 question, this has been asked in December 23 new syllabus also. CA final past exam question, that to May 23 question asked in December 23. So from CA final May 23 question paper, 3 questions were asked. This is one among them. Question number 5. Security market line is nothing but CAPM return. Okay. If you couldn't derive a security market line, then that's okay. But you have to try first part and second part. Clear? So for today, it's question 5 and important question. How many questions? Three questions. You have to try these three questions. Jamuna, Karthikeyan. Okay. Generally, students fail because of the reason. One of the main reason is they don't know how to prepare. They do hard work. They study for 12 to 16 hours, but they don't know how what to study and how to study. So that's why I'm giving you homework. Okay, you need not practice the questions which were discussed in this class. I'm asking you to solve the other three questions. Clear? Sharp ratio, trainer's ratio, frequently asked question. If you see the scanner in mutual funds, you will find lot of questions. Okay. Solve these three questions. And my request to all Saahas Pm students is I'm recording English marathon. I will be uploading English marathon by next Saturday. Okay. And immediately after completion of portfolio management chapter, just go through that marathon also. Derivatives also. Likewise, parallelly, okay, you just half an hour a day. You watch marathon half an hour a day. That would be sufficient. Okay. So that's why I have not taken class on Saturday. Okay. Today also I'm not taking class, second session. So from tomorrow I will be taking two sessions. Clear? From tomorrow, two sessions. And don't worry about syllabus. I will take time for portfolio management, mutual funds, and derivative analysis forex. The other chapters that will not take much time, especially digital finance, securitization, security analysis, even security valuation also that can be completed in less time. Okay? Done. Everybody please solve these three questions and whether you got answers for last session homework or not. Additional question. Because if you are able to solve those additional questions, that means you are reached to next level for sure. Without any hesitation, I am saying it. Last in last class, I have given you homework to. I asked you to solve the question number 9. Yes or no? 7, 9, 7 to 12. If you are able to solve 7 to 12, that means you are reached to next level. Confirm you're going to get an exemption. Why? Because the reason is those concepts are linked with derivatives also. Actually, those are derivative questions. So we have not yet completed portfolio management completely and we have not yet started derivative analysis. Even then, if you are able to understand and if you are able to solve those questions, that means you are reached to next level. Whether you have done those questions or not. Else, I will discuss those additional questions after derivatives, after completion of a derivatives. Okay, clear? Actually, that concept is derivatives, but we discussed in portfolio management only. Reducing the beta to 0.8, how much risk-free investment should he bring in, etc. Jamuna, you solve those questions or not? Karthikeyan, let me know. Everybody, please. Everybody, please respond whether you solved those questions or not. Arun Venkatesh, Kanmani Parashuraman. Kanmani, you are not attending class in class plus. Why? Even if you are not getting answer, that is not a problem. But whether you tried or not, that matters. I want everybody to try the questions which I am giving homework. Otherwise, the purpose will not get served. Done. Okay. So try these three questions. Okay. Thank you, everyone. Thank you all. Thank you so much.